What's up, everyone? It's Caddy with Money Vesting. So in this video, it's gonna be your daily dose of bearishness. So I'm gonna break down a couple different reports that came out today from JP Morgan, Arbitrary Investments, and Bank of America that pretty much do suggest not very good stuff about the markets here. So we're gonna talk a little bit about the S&P 500 earnings per share. We'll dive into the technicals a little bit, and then we'll also talk about the dollar index, the yield curves. And then, of course, not to mention a thing that I've already mentioned before, and that is going to be the interest rates, the federal funds futures, and we'll talk about that as well because now there has been a big shift in the Fed funds futures, and the market right now is anticipating a very small probability, about a 4% probability that interest rates are actually going to go up to 6% by July. Yes, 6%. That's definitely going to be a lot higher than what the market was anticipating before just a few weeks ago. So hope you guys enjoyed this video and find it helpful. It's definitely going to be more enjoyable for people who are expecting more downside or are, quote unquote bearish on the markets right now. But hope you guys enjoy it regardless. And if you do, make sure that you drop a like. Don't forget to subscribe to the channel. Hit that notification bell so you don't miss out on any future market updates and videos and live streams. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, investing alerts, swing trading ideas, and a lot of other private videos and content on Discord and Patreon as well. So link's going to be down below. So the U.S. stock market, as measured by the S&P 500 index, appears to be exiting the, quote, best era for growth in earnings per share in decades as sources of liquidity have dried up, according to research from Bank of America. This actually came out very recently, literally today. And the S&P 500's earnings per share are, quote, more cyclically peaked than ever from low financing costs, buyback-fueled growth, and peak stimulus. Equity and quantitative strategies led by Savita Subramaniam said in a BofA Global Research note on Tuesday, and quote, secular EPS growth is at a multi-decade high. BofA, which has forecasted the S&P 500 will see a $200 earnings per share in 2023, which obviously is a lot lower than what we calculated at 218. $200 and 4,000 S&P puts us at a 20 times PE multiple, which in my opinion is still a lot higher than where we should be trading at. In other words, 15 to 16 times earnings. But they go on by saying in that note, and I quote, now is not a time to buy the crowded market index. But the strategist said that shifts in liquidity should drive opportunities within and outside of the index. She says, and I quote, we may be exiting the best S&P 500 EPS era, but we are likely entering the best stock pickers market in our careers. We recommend being invested in equities, but selectively. Furthermore, the S&P 500 gauge of the large cap stocks in the US, of course, is up over 4% so far this year based on Tuesday afternoon trading. Of course, it's now up just about 2% for the year. And the index's communication services has soared over 11% for the year so far, while companies in the materials and utility sectors are either flat or down. So materials are up 3%, utilities are down 5%. And they go on by further saying, and I quote, we like the capital deprived sectors. Financials, home builders, materials, and fossil fuels are areas of the market that have been starved for capital and for more than a decade. And while technology is among these that have enjoyed free money, amplifying the duration risk of the S&P 500, but bloated growth sectors still need to rationalize capacity after overbuild, and deflating the treasury bubble will be unkind to bond-like and long-duration stocks such as growth and tech. So that's really what they mentioned. And, they also talked a little bit about the dried up liquidity. There's been three sources of how the liquidity has been dried up. The first, of course, there's been quantitative tightening as the Federal Reserve is allowing for the bond holdings to run off its balance sheet. They're no longer buying treasuries anymore. So the two biggest buyers of treasuries, which is both the China and the Fed, are done. That's what they that's what they wrote in that note here. And fiscal stimulus is, quote, unlikely. And on the fiscal front, the strategist cited the possibility of a, quote, gridlock in Congress along with deficit hawks nuclear option, using the debt ceiling to force spending discipline. And now companies are belt tightening with the layoffs seen in many areas. So They are expecting the S&P 500 earnings to not grow at a pretty substantial rate because of the dried up liquidity, and then tightening of the belt from a lot of these companies, and of course the Federal Reserve and China not being the big buyers of treasuries anymore, until of course there's a big shift in the overall macro picture. But right now they are suggesting that this is not the time to be buying the overall aggregate market index, but instead being very selective in picking individual stocks, so to speak. Now, another report from Mark Arbiter, president of Arbiter Investments. He's more of a technical analyst, and his analysis is pretty much on point with what I showed you guys earlier and what I've been kind of analyzing myself on a more technical basis. And this, came out today, and he identified a, quote, a very interesting cluster of support just below the Tuesday low for the S&P 500, with the convergence of the pair of the trend lines along with the index's 50 and 200-day moving averages at 39.70. So if you come over to this chart, this is his technical analysis, kind of going over to the lower highs, which is in dark blue, and he's also identified the higher low, which is in red, and that's the X over here that we also identified in our own analysis. So if you come over to the S&P 500, you'll notice that on the daily chart, this is exactly the X that we're talking about. That's the higher lows inside this sort of uptrend. That's the green line you see on the chart, and the lower highs sitting over here, which obviously we've been getting rejected at since the beginning of this bear market in January of 2022. So that convergence or that confluence is going to be incredibly important. That's going to be sitting roughly at around 39.70. So it's going to be very important for us to see whether the S&P 500 kind of holds up as that support or continues to break down even further. So that's the big cluster of support that he's referring to in that report, which is going to be really interesting, and that's also going to be true for the NASDAQ, because the NASDAQ is also coming down to very interesting levels right now, coming down to 11,500. That's also a very strong support at the moment. Now, moving over to JP Morgan Chase and Company, and they also talked about how the stock market bulls who see recession as off the table and await the next leg of the rally are setting themselves up for disappointment, as a fallout from the Federal Reserve's monetary tightening is, quote, still ahead of us. It is premature for stock market investors to believe that the pain to the economy from tighter monetary policy is already behind us or well absorbed, as the impact of interest rate hikes typically feed through the economy with a lag of between 1 to 2 years. And that, I think, is actually really, really true, because as we have mentioned before, that the market obviously is a very fast moving mechanism, that it prices things in almost instantaneously, but the economy is a very slow moving train. It takes longer for the wheels to turn, and as interest rates go up, we're not going to see the effects of these higher interest rates maybe 6 to 12 months from those higher rates. So it's going to take time, and yes, we have seen unemployment stay low. We have seen the economic growth kind of relatively good, and we haven't really seen any significant deterioration in the overall economy, but it's still a possibility. It can still be in front of us, considering how high rates are going. And we'll get to rates later in just a minute. I'll go over the federal funds rate here in a minute. But JP Morgan further goes on by saying, and I quote, we have looked for an equity rebound since fourth quarter of last year, driven by stalling yields, China reopening, and our view that natural gas prices would fall. While we believe that Q1 can initially stay robust, which is the first quarter of 23, we do not expect that there will be a fundamental confirmation for the next leg higher and see rally fading as we move through this quarter, with Q1 possibly marking the high for the year. So in other words, they're expecting this to be the peak for the market in the first quarter, and then drifting lower and pretty much fading further down. Historically, equities do not typically bottom before the Fed advanced with cutting, and we never saw a low before the Federal Reserve has even stopped hiking. And of course, we've seen the yield curves also inverted. So this right here is the inversion in the yield curves, which continues to steepen even further, sitting at negative 70 basis points between the 10 and the 2-year curves. So that obviously precedes a recession. Not every time. The probability of this happening is actually really high, but it's not perfect. Now, going over to the interest rates, and this is where things get a lot interesting, is because what's happened now is that there is actually a probability from market participants that we may see a 6% terminal rate. And this right here is 5.75 to 6% from the market, from the Fed funds futures. And what you'll notice is that 1 week ago, this probability was 1.34%. And this is by July, if I'm not mistaken. This is by September. So September, we've got a meeting in July 26th, but we've also got a meeting in September, so no meeting in August. But even if you come over to July over here, you'll notice that there is, again, a rising probability that we may see 6%. So 1 week ago, this probability went from 0% to 1.45%. Then it went up to 1.99, almost 2%. And as of today, as of the right now, we're sitting at 3.72%, almost 4%. So you can see how consistently there has been more and more expectations from Fed funds futures that there is a possibility, however small, there is a possibility that we see 6% as a terminal rate from the Federal Reserve in terms of interest rates. Now, if that ends up happening, I think that's going to really shake things up here in the markets a little bit, because nobody right now has been pricing in 6%. And if the market starts pricing that in, that is not going to be super great from a tech and growth standpoint. We're going to be back to 2022 sort of sentiment and predicament where interest rates keep going higher, markets keep drifting lower, and we're going to have some bear market rallies thrown in there, sprinkled in there somewhat. But overall, a 6% terminal rate is certainly going to put the markets under a lot of pressure, unfortunately, from a more macro standpoint. So just wanted to go over that. That's where we are. And like I said at the beginning of the video, this is going to be more of a daily dose of the bearishness for those who are anticipating the markets to pull back a little bit. But it's important for us to have a more realistic outlook on the markets, right? It's really detrimental for us to always be bearish or bullish on the markets, and regardless of what's going on in the economy, just continue to be bullish or continue to be bearish. We need to have a more well-balanced approach, level-minded approach, and kind of really understand what's really going on with the Fed funds futures, with interest rates, with unemployment, with inflation, all these things which really do drive the markets. And if that's the reality, if you're kind of seeing something, if I'm seeing something, I'm going to call it out. I'm not going to ignore it just because my personal bias is that I'm bullish or long or, bearish or whatnot. So I'm going to be very objective as I try to be. Hope you guys enjoyed this video. Let me know your thoughts on the markets right now. We're definitely in a very, very interesting technical support, but more from a fundamental and macro standpoint. There's still a lot of uncertainty, a lot of unresolved data that we need to fix. And of course, we got the next meeting in March from the Federal Reserve. March 14th, I believe, is when the inflation numbers come out. And then March 22nd is when the Federal Reserve's meeting is moving forward. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. As always, happy investing, and I'll see you all in the next video.